How do you price multifamily and mixed-use assets in any market? Hello, everyone. For those of you who are here for the first time, my name is Mikhail Kirkjan. I'm broker of record, and I'm also a real estate investor. I'm licensed to trade in the Quebec and in the Ontario markets in Canada. I've been in real estate for the last 20 years. So the last 20 years has been phenomenal for those of us who have been in this industry. We've learned quite a bit, and we've seen so many market cycles. If you're a real estate investor, or if you're looking for passive income opportunities, or if you like rental properties, if you've been investing in multifamily, commercial real estate, or if you love investing in general, you've come to the right place. The purpose of my video today is really to look at pricing. Why is pricing so important? Because pricing is the number one feature of getting a property sold. If you're a broker, if you're a buyer, if you're a seller, everything starts with the pricing. And having been involved in real estate for all those years, I've seen many properties go to market at the wrong prices, not sell, expire, and it really tarnishes the reputation of our industry. That's why it's very important, I find, for me to share with you proper methods of pricing properties. That way, whether you're a seller or buyer, whether you're a broker or investor, it doesn't make a difference. You know how to price properties properly, so then you can then figure out what a property is worth before even getting started on the process. So I've broken this down really into 6 different steps. And these methods you can use in any market pretty much. And I will basically start with you with step number 1. Step number 1 for me is going to be the demographics. So if you're looking at a property, before you do anything, just figure out, okay, this property is located in location X. Look at the demographics. There's going to be all kinds of companies that provide this. In Canada, there's a company called Sidewise. In the US, there's a company called Geolytics, or I'm sure there's multiple companies that do this as well. But basically, what you want to look at is figure out, okay, this property I'm looking at right now, over the next, let's say, 5 years, 10 years, is the population base growing or is the population base shrinking? If the population base is growing, it's going to be good for rents, and it's also going to be good for the inflation of the rents. If the population base on this area is shrinking, then you have to basically price it a bit differently. So demographics is the number one thing to look at to make sure that where you're located is going to be an area that's going to be growing in population. Number 2 is going to be the location. Why is location very important? Because there's a saying in real estate that says that location, but that's not what I mean. Because what I mean is that with location, if a property is located in a AAA location, if it's, let's say, downtown, or it's right next to a metro station or a subway station, right next to a university, or AAA prime and prime, those kind of properties tend to be very expensive on the way in. Why? Because the seller and the listing broker, they've kind of priced the property in such a way because they're saying it's a trophy asset, we're looking for a trophy price. And someone's going to pay the price regardless of what the cash on cash is. So if you're buying that kind of property, that location, you'll be buying it where you're going to have more appreciation in the future because location is really AAA, but the cash flow is going to be weaker. Meanwhile, if you went to some other, let's say, B- or B+ location, you'll be buying a property that's going to be appreciating a bit less, but it's going to be generating more cash flow. So make sure before you get involved in the acquisition that this location is going to be something that you're looking for. If you're looking for really cash flow, then there's no point for you to look at AAA locations because the AAA locations, they'll be providing no cash flow. Number 3, the third step that I'll look at is going to be the property condition. So very important as a real estate buyer and seller, and also broker, of course, to look at the property condition, because there's no point to make an offer for a building, let's say for $5 million. This actually happened to us this week. We were selling a building, something in the range of mid fives. The buyer made an offer. Then they brought all kinds of inspectors, verifying all kinds of stuff. Then they came back and asked a reduction in price of 10%. 10% reduction. That's ridiculous. Who asks for a 10% reduction in price? That's why I find make sure you do your analysis properly. Look at the property before making an offer, before looking at everything. Ask the hard questions. How old is the roof? How's the foundation? How old are the windows? How old is everything? What's the capital expenditure needed in the next little while? And the property is asking, let's say, $5 million, and you're calculating around $200,000-300,000 of rentals. Don't make the offer of $5 million. You're figuring the property is worth maybe 4.6, 4.5. Make the offer at that price. There's no point making an offer at $5 million, and then you bring an inspector that tells you you need to do a reduction in price of $200,000-300,000, and then you go back to the seller. Seller says no, deal falls apart. Everybody wastes time. So basically, look at the property condition first, and then make your offer accordingly. Assessing what the condition was. Just have the inspector come and do his inspection just to kind of confirm your analysis. But don't be relying only on the inspector. You should know what the property is worth before even bringing an inspector based on your analysis of the property condition. Next thing I would look at is going to be step 4 would be the actual units. Are the units good sizes or are they small? If the apartments are larger, they'll be renting at higher rents. If the apartments are smaller, they'll be renting at smaller rents. Also, how many units are in the basement? For example, if your property is 20 units, of which 6 are in the basement, well, those 6 in the basement, they'll be renting at lower prices than the apartments in the floors. So make sure you pay attention to units and the unit sizes. Also, some locations, for example, if it's right next to a university, those areas, you'll be able to rent the apartments that are small because you can rent to students and so forth. But let's say if that property that was all bachelors is located in an area where your tenant base is going to be all families, then you're going to have a lot of vacancy. You're going to have a hard time renting those apartments. So make sure you pay attention to the units and just make sure that the unit mix and unit size is making sense for your property location. The next step I'll look at, step 5, is going to be the upside in the rents. Upside in rents. Why? Because if the property is, let's say, on the market, asking a cap rate that's very aggressive. Let's say it's the selling cap rates are, let's say, between 4 and 4.5%, and these guys are asking 3.7% or 3.6%. But then you discover that the upside in the rents are going to be something like in a range of maybe 100%. And you say, wow, you know what? If every single tenant leaves, I'll be able to double the net income here. So in a case like that, you'd probably be okay going a bit more aggressive on the cap rate because you could say, you know what? Even if I buy it a bit aggressive, once these tenants are leaving, I'll be doubling the rents eventually after I do my renovations and so forth. So I could be a bit more aggressive. Meanwhile, if that same property was again asking, let's say, a cap rate of 3.7, 3.8%, and the upside in the rents was maybe just 5% or 10%, you can now do the same analysis. So make sure you look at the upside in the rents because that's going to give you an idea about where you should be for the cap rates. The more upside you have in the rents, the more you can be aggressive on the going in cap rate. Now, the last step, which is going to be step 6, that we'll look at is going to be 2 steps really hand in hand that go hand in hand, is to look at the sold comparables. What are things selling for in this area, let's say, in the last little while? I mean, don't go back too many months. I would say go back probably 2, 3, 4 months because that's going to be very accurate also with the going in interest rates. Interest rates and the sold comps go hand in hand. Why do these go hand in hand? Because if you look at our current market, this is a great example of our current market. What happened in our market, let's say the last 12 months. A year ago, interest rates used to be around 2.2%. Today, if you go to the bank for financing, conventional loans in Canada are in a range of 5 to 6%. If you go with CMHC insured loans, you could be in range of maybe around 4.5%. Now, on a property that you're buying, let's say on an amortization of 35 years, if you had bought a property that had a net income of $100,000 net income, that same property a year ago would have got a loan of something in the range of plus or minus around 1.8 million. Today, that same property, you go to the bank, you're getting a loan of something in the range of plus or minus 1,360,000. So all of a sudden, you've lost quite a bit on the financing for the loan just because of the fact that you had the same net income, but interest rates went up quite a bit. A year ago, they were maybe at 2.2%. Today, you're in a range of maybe 4.5%. So that's why that exact same property, let's say if you were going to be buying it a year ago at 2.6 million, it was going to require a down payment of, let's say, around 700 grand. That same property today being sold at this exact same sale price of 2.6 million will require a down payment of around 1.2 million. Obviously, it's not going to be selling at the same price when interest rates are at 4.5% versus when interest rates were at 2.2%. So that's why make sure you get proper comps in the last couple of months and also pay attention to the interest rates, because if interest rates have gone up or have gone lower, it's going to have a significant impact on the actual sale prices. That's why you're seeing today in this market, a lot of properties are going to market. They're trying to get the same pricing as a year ago, and they're not selling, they're expiring because of the fact that interest rates have changed, yet the sellers and the listing brokers have not taken that into consideration. So I hope you like this content. If you like this content, follow more on this channel. If you want to get notifications whenever I post more videos, just click on the notifications bar. And any comments, any questions, please go right ahead and put them below.